Hey everyone, welcome to another episode of Pitch Deck Insights. I'm your host, Litan Yahav from Visor, and with me are my good friends Hans Box and Mike Arndorfer. Together, we've done more than 120 LP investments into real estate private equity deals. And our objective here is to teach other LPs what to look for in a deal, how to vet a deck fast, and understand the pros and cons of the deck and the deal. Let's dive into this deck. All right. So this is a deck submitted by Break of Day Capital. By the way, we don't get anything from these GPs. We're purely trying to teach LPs how to vet these deals. Same goes with this one for Break of Day Capital. And let's dive into it. So the first few slides obviously are the firm's intro, their disclaimers, the company overview and all that stuff, their mission, core values. All this is like important stuff. You want to read through it and understand who the firm is. But then we dive into sort of the next section, which is sort of the background of the team. Now, Hans, do you have anything you want to say about sort of this Gary Lipsky slide?
Sure. Yeah. So this is essentially his bio. My first comment generally is I'd like to see a bigger and a longer bio, but I do love to see the operational experience that he has, even though that operational experience was through owning a company. I mean, essentially, when you buy multifamily and you do syndications, you are running a company as well. So having that strong operational experience is a big plus. One question I would ask from reading this slide is, he says that he has 3,000 units in experience in multifamily, but I want to understand, was he actually the GP in these? How was he involved in these 3,000 units since 2002?
Yeah, that's the same question I have. A lot of times it may be that he's been the GP the whole time, but I see a lot of decks where they maybe started out as an investor and they've been investing since 2002, and then they flipped over to being a GP in 2016 or something. And so it makes it seem like they have longer experience than what they really do, which there is some benefit of being around multifamily and investing during that time frame, but it's not the same as running deals. So I would just that'd be a question to ask.
Well, I have a question on that. So you think if it's been active, like if he's done 3,000 units as an active real estate investor, is that a pro or a con from a deck perspective?
Pro. I mean, if he started as a GP and has been
not a GP. He didn't raise money, but he did it on his own. He just bought houses, flipped them, operated them on his own.
That's quite positive. Yeah,
I'd say that's still positive. Yeah. Because he's gone through the cycle. He went through, the Great Reset. So he's seen the run up before of 02 to 07 and the crash from 8 to 12 and lived through it. And even if you're doing single family, there's going to be a big benefit with it. And even just being a real estate investor during that time frame is going to be helpful and help sort of educate somebody. But it's one of those that I would want to clarify what exactly his experience was at different times and how long has he been doing this specific type of multifamily as a GP operator.
Right. All right. So moving on, basically the team background as well. Extensive team. Mike, you have anything to say about this?
No, I mean, it is good to see that this is something where, obviously Gary's been doing this. He takes it seriously. He's got a big team built up. This is a little different than some of the decks where you'll see partnered with a law firm or something. Like these are actual people that are working for the company and part of the team. So I would say that's a good sign.
Hans, anything to add?
No, agree.
All right. So still sort of on their experience. Anything here we want to talk about, guys?
I would just say it's somebody who has, like lots of people can write a book and have a podcast. It'd be the type of thing that if I was going to invest here, I'd maybe want to listen in a couple of times, see what this guy's like. That's a great way to kind of come in. Same if I was going to invest a lot of money. The best in class book would be something to sort of read and see, when did he write it? Does my philosophy with him fit that?
Their market expertise as well. So this is sort of going into the background and now what they do in sort of historic deals, right?
Anything I do have something to say about that previous slide right here.
All right, let's do it.
They talk about they increase the NOI by 40% NOI increase, which is great, but honestly, that doesn't mean anything because there's no context here. As an LP, you can't just take numbers and an increase with a grain of salt without asking questions. And so, my questions are, is that a pretty even increase across all 7 properties he owns? Was that 100% of one property and another property was 0? That's one question I want to ask. Was that mostly revenue driven or was it expense cuts? Is that are we assuming a 40% increase compared to prior owners, or 40%? But then that would mean that he bought all 7 in the same year. So that's certainly in the case. So it's very confusing just to say 40% NOI across 12, across a portfolio, without having a lot more details on that. So
I would guess this is one property, and he just took a best case scenario that he did once and put it in here as an example. But that's
it says across portfolio, Mike. So I'm not sure that he means that. I'm getting the sense it's some sort of an average across a portfolio, but I'd want to understand. Oh, like I said, all those details that I just asked, I'd want to ask those questions. So I would understand really what does that 40% actually mean? I need context.
Right. I think what he's just trying to say here is that they're using the beam strategy and methodology in real estate, and that's what's a driver for increase. But these are definitely questions that need to be asked by LPs interested in the deal. Some pictures of like historic deals before and after, interior renovations, historical highlights of their historical deals. Anything you guys want to say here, Hans?
I mean, the IRR is great. We're going to touch on track record a little bit more later. So I have quite a, in the next slide, I have some questions around that for sure. But the IRR is great. 23 million in distributions. I've seen this in other decks, and quite honestly, that doesn't mean a lot to me because again, there's no context. 23 million doesn't mean over what amount of time, over how many properties, et cetera, et cetera. It doesn't have a lot of context. So an absolute number like that doesn't mean much, but the IRR is great.
Yeah, IRR is amazing. Mike, anything to add?
Yeah, no, I would agree. And then the no capital calls is nice, but you're going to want to know, how things are looking at in this deal and where it is that way.
Right. All right. Moving on. All right. Full cycle performance of those 3 deals they mentioned in the previous slide.
Yeah. So the IRRs are high. Wonderful, right? It's great. But keep in mind, these are very short. He's essentially flipped these 3 deals. He owned them for a very short amount of time, less than 2 years on average. So that's essentially flipping these deals. So when you buy and sell a deal quickly and have a decent return, the IRRs will get pushed very high. And so you've got to remember that when you're looking at that kind of thing. I would ask questions around how much NOI was increasing, as much of this may had to do with cap rate compression. He appears to have bought and sold these during a very frothy time in the market where cap rate compression was happening in the Phoenix market, especially. And so I'd want to really understand how much of that, the equity multiple of 2.23 average was cap rate compression versus NOI increases and him hitting pro forma NOI, not just hitting pro forma sales prices. I'd want to know the purchase dates of these deals because I want to understand when these were bought and sold, but I'm pretty sure these were bought and sold during anywhere from 2019, 2020 through 2022. And my biggest question is really, how are the 7 that he currently owns performing against projections? That's what I'd want to know now when time's a little bit tougher.
Yeah, I totally agree with these are amazing returns, right? But it's all about context, and when these happened is important to emphasize. I agree on that, and the current deals as well. Now we're sort of all right. This is sort of the background of getting you into this current deal, right? And sort of why investing in multifamily and diving into reasons and then into the deal itself. So breakdown of the investment classes, probably in this deal and other deals as well. Anything about this?
Yeah, so there are a couple things with this. One, the Class A, whenever there's Class A shares, if you're going to not be a Class A person, you're going to want to know is there a cap on that or what they're expecting for that to raise, because those people are going to get all of their money back plus their 10% before you get any of your money back. And so you don't want that to be too high, and you kind of want to look at that almost like debt, because it's going to go bank debt, then your Class A people before the Class B and C get anything. So just to be aware and ask them where that's looking like that way. The other thing on these is I can see why a lot of times they have the B and C classes, because it's a lot better if somebody can write a 10x check. But when you look at the splits with an extra 1% preferred return, and then the bigger deal for me is that after a 15 IRR is not super early, but it's pretty early for a class B to drop from the 70-30 to 50-50 versus if you can get into this class C, you're at 80-20 the whole way. So I know Hans and I are in some different groups and things, and a lot of times what we'll try to do if I was interested in the sponsor, I would see, are there any of the groups that I'm part of, or can I form a group that we would be able to come in together to get class C shares, because there's a huge advantage to being class C over class B.
If there's preferred equity in a deal, you've got to understand where that is in the capital stack and how high in the capital stack it is. So if you have debt of 60%, and then you have another 20% of preferred equity, that means the leverage on the deal is really 80%. And you've got to understand that as an LP.
Yeah.
Right. Yeah. Personally, I think the jump from 70-30 to 50-50 is a little aggressive, but I've seen it before. I don't necessarily like it, but it's also
yeah, I don't have a huge problem with that because he has experience, and it has a pretty good track record. But again, it's about the entire deal and the fees and the track record. That's where I don't take waterfalls like that, in a silo. I look at it as a combination of things.
That makes sense. All right, let's move on. Projected returns on this deal based on 100,000 investment.
Yeah, I mean, my first question, I think it's pretty evident this is for common equity, but it is not labeled anywhere. He just showed 3 types of equity, but then shows projected returns, and it's not labeled which class of equities this is for. I'm pretty sure this is for obviously common equity, but again, you just need to, when you read these decks, you got to make sure you understand the context. Note how thin the cash flow is. It's very slim, even in years 4 and 5, after it's had time to raise the rents and implement the value add. And so that kind of tells me that there isn't a ton of value add in this deal, and it has pretty thin margins. And that means almost all of the return is gain on sale. And so when you have lower cash flow, that typically means that you have less value add. When you have less value add, you have a higher, in my opinion, you have a higher risk because you have a lower margin of safety. And when all of your gain or the vast majority of your return is coming on the gain on sale, that just adds risk to the deal. So just something to be aware of. Not saying that's necessarily a bad thing. This may be, just how this market is, but it is something to note. I prefer to see cash flow ramp up a little bit higher, or have a refinance where I can pull money out first, instead of all my gain being predicated on a sale in year 5.
The biggest thing that I got from this was the 2% in year 1. And that's probably after some value add is factored in for whatever they're doing. It's really thin. Which I'd want to dig into DSCR coverage and stuff like that to just make sure what type of occupancy do you have to have? What are they putting in? And because it's a very thin margins, make sure that there's some safety in other places that you're not going to get in trouble.
What bothers me more isn't really the low cash flow in years 1 and 2, because you have to leave time for the operator to actually implement the value add. It's because in future years, it doesn't increase very much, and that's where it concerns me.
So you're saying if it was 2 or 3, that'd be fine. If you'd see year 3, 4, ramp up to 7, 8%, then it would make more sense.
Yes.
All right. Okay, let's move on here. All right, some pictures of like the deal itself. Some historic, or the location itself of where this deal is located. There's some numbers and metrics. I don't know if there's anything you want to say about this.
I mean, the only thing I have to say is it's for a county, but I want to see demographics and info on the submarket where the property is, not on the county. County's great. You can always have that info, but it's really more about the area, this immediate market.
Right. And we see that coming in a bunch of decks. Like, they don't dive into the actual location of where the property is located, right? And then key industries in this, I don't know, location, region, city. Acquisition highlights, summing up probably the location and the opportunity.
Yeah, so I do have something to say about this slide.
All right.
So they talk about a 20% reduction in price. I think they say here in that third bullet, 20% reduction from 15 months ago. Again, this isn't really relevant. 15 months ago, the market was a completely different place. And to say that you were getting a reduction from prices that were too frothy to begin with isn't really a reduction, in my opinion. So you've got to understand again, it's all about context and understanding history and understand the market as an LP and ask questions, because everything was more expensive 15 months ago. I do like that he has properties close by. That tells me he probably knows the market really well and may have some critical mass there and be able to reduce operating costs because he can share employees. I love that part. It looks like the upgrade opportunity is good because there's a 40%, you can upgrade 40% of the classic unit interiors. But the problem is that no rent comps have been provided in this deck. And honestly, no sales comps have been provided in this deck. So there's no way to actually judge whether or not this value add is legitimate or not.
Yeah, the other thing that I would say with that is that, the previous owner completed 3 million of CapEx project. Great. It sounds like 60% of the units have been, updated, but that means you're buying it from another investor. You're not buying it from the original person who's had it a long time. And a lot of times there's a lot more value add in something if it's been in the same family for 20 years, 25 years, and the whole thing is more tired. And so it's just another thing that it tells me that there's probably not a lot of super low hanging fruit in the value add part, the person before you did it. So I'd want to ask them some questions too, kind of why are they selling, and that sort of thing.
By the way, did you notice if they're fully like vertically integrated or not? Like when they say they have 3 properties under management, do they also have a property management company, which even
it looked like it. They had on their deck to be, that's the slide that had the different people. There's an operations manager. So the combination of Gary's written a book on operations of these things, and then you got Jacqueline as the ops manager. I'm assuming that they're they're operating this themselves, which is good. I typically would like that. It's not a requirement, but you want to make sure that the person that is operating it is on plan and stuff. There's too many decks, obviously not this one, but there's too many that don't sort of breeze over that part, and don't make that an important thing. And it is very important on the success of the deal.
Right. I'm just used to, if an operator is vertically integrated, they're going to emphasize that at the beginning somewhere.
Yeah, usually they would. I'm not sure. It's hard to tell here.
All right. So that's another question to ask, I guess. All right, acquisition overview. Mike, you want to kick this off?
Yeah, I mean, occupancy rate at 90%. I'd want to know, what's going on with that. Is it because they're in the middle of value add? Are they having trouble or rent's high? A little explanation with that would be good, that way. And then you've got 40% of the units I'd like to see a little bit more on the renovation budget. And I can't remember if it's coming or not, but just to sort of like make sure that everything makes sense with what they're doing that way.
Hans?
Yeah, so first thing I want to talk about is the debt. It's a 3-year fixed rate debt. Why is he getting 3-year fixed rate debt? Especially, there, to me, there's got to be a good reason for that. So I want to know the full debt terms. I want to know who the lender is. I want to know everything about it. I would typically want to see at least 5-year fixed rate debt, with maybe you could structure low prepayment penalties built in. I don't think the argument to say no prepayment penalty is a reason to get 3 years fixed rate and then get yourself a gun at your head in 3 years. I mean, that's what's happening to people right now. So I would be I'd ask a lot of questions around the debt and why they chose to use this debt. And if they have good reasons, that's great, but no details provided here. Note that he's projecting this to be a flip again, just like his other deals, 2 to 3 years to exit. However, on the projected return slide, it was a 5-year hold with the exit shown in year 5. So there's something not congruent there. That worries me a little bit that there's no congruency on the slides here. And if the debt really is only 3-year debt, which it appears to be, has he run scenarios on a refi? What happens if you can't, if selling in 3 years isn't the right time? I want to know what my returns would be on a proposed refinance versus a sale. Because in one slide, he's saying 2 to 3 years, and the next slide, he's saying 5 years. But there's no refinance scenarios presented anywhere in the deck.
All right, makes sense. About the LTV, all right, so it's 69%. Is there a number you guys think is like a red flag or a number that's amazing? Do you look for like a 69%? Is that good, bad? Does it mean anything?
Again, everything is in a context of a deal. If this is standard agency lending, agency isn't going to lend over a 1-to-5 debt service coverage ratio. 69% is fine. It's totally fine. Nothing at all wrong with, that I assume that's loan to purchase price. So no,
I don't think
obviously,
it is, because he's got LTC there. And so LTC, which I would say is purchase price, is 60%. And so it looks, I would at least read this, that the LTV is what he thinks the current value
well,
is.
loan to cost, Mike, will be the purchase price plus his rehab. So that's why he's got loan to cost. There's just total cost in the deal. That's why the LTC is lower. LTV is the value of the deal, what he's buying it at 69%. So that's the reason.
So you think the 60% is 35.4 million versus the 69 is
I don't know about the numbers. I haven't done the math, but loan to cost means it's total costs. And the total cost isn't just the purchase price. It's a purchase plus a rehab. Yeah.
Right. Mike just added the 33 million plus 2.4.
Oh yeah, probably. Yeah.
All right. Cool. Moving on here. Now they're diving into the renovation budget. And this is something that we haven't seen a lot in decks before, or at least those that we reviewed. What do you guys think about this slide? Mike? Mean anything to you?
It's good. I would just like to see a little bit more, because they said that there's 40% of the units that are still original. Just a little bit more detail on that, because it's going to cost a little bit more on the 2.2s versus the 1.1s. But just, I like it. I like what we have. It's just, I'd like even a little bit more detail. Maybe make my picture just a little bit smaller and give me a little more per unit cost type stuff.
Hans, would you agree with that, or any other insights?
I think it's fine. To go into detailed unit renovations, that gets very granular, and there's really no way to validate it, how much a granite countertop versus the backsplash versus the cabinets versus the flooring is going to cost. I look at that 1,228 and do some math on how much of that is per unit and see if that makes sense. I don't know what that is, because I don't remember how many units this property is. So 40%.
Yeah, it's about
number of units.
The 40% would be about 103 units. So then you just want to look to see is,
yeah, so it's 12,000
like
a unit.
That's per unit.
Yeah. So it's pretty good rehab budget.
You guys know what they mean by CM fees?
Construction management fees.
So it's not their teams who are doing it, probably. That's what you're saying.
It's hard to know. They don't.
Right.
That's another problem I have with this deck, is there's no sponsor fees disclosed anywhere in the deck. Yeah, they have the CM fees there, but we don't even know who that's going to.
All right. So basically, yeah, we want to see what the fees are and ask that as a question. Water conservation. So this is just like the decreased cost, right? Basically.
Yeah. To be honest, it makes me a little nervous that this is their big value add. Hans, what did you think on this being called out, and sort of how they're, saving all this money? Does that concern you, or do you think that's legit?
It may be legit. To me, it's de minimis. It's not what I'm interested in when I'm looking at a deck like this. I'm interested in where they increase revenue. Where you decrease expenses because the prior owner was running it too costly is kind of irrelevant when you look at it. Any value add, you care about where the income is being increased. The expenses are going to be ran where they are. You're not creating value by decreasing the other guy's expenses, because supposedly he's selling it at a cap rate based on his expenses, not yours. So it's all about revenue to me. So I kind of gloss over stuff like this.
Okay.
But it's a great way to save money. I'm not saying it's not. It's just, it may be fine.
I just want to say a point on that, because I think it's an important point. So there's the NOI increase, right? You either decrease expensive, increase revenue, right? And there are ways to make the operations more efficient, save costs, automation,
of course,
whatever.
Of course.
And so I think
you're buying at a certain cap rate based on the seller's numbers, not yours. So typically, you're looking at a T3, and then your pro forma expenses when I'm looking at a going in cap rate. This is going to get way too technical, and it's going to gloss over people's heads.
All right. So let's continue and then dive into the pro forma, maybe talk about it there. So these are, like, again, some pictures of what they're going to add in, floor plans of the apartments themselves, rent roll summary. Anything you guys want to talk about this, Hans?
My comment here was, this is presented, and unless I'm reading it wrong, this is presented as if all units have some sort of upside for upgrades. You guys tell me whether that looks like to you, but then they said, the previous slide said only 40% are eligible for upgrades. So it's confusing to me, because they're showing all units it's very confusing.
The
Again,
other
it's
thing with the
incon-
in-place rents is you don't know the difference between the 60% that have already been upgraded versus the 40% that are still original. And so, yeah, it's sort of a confusing slide that way. Since versus if this was something where you were buying it from someone who had it for 20 years and had never upgraded anything, then it would kind of tell you where you were at.
So, I mean, there are, two types of rooms that have a bigger bumps percentage wise than the two other types. So maybe the two other types were already renovated and they're assuming some sort of other method to increase rents, whereas
Could
the
be.
25%
Yeah,
might
but
have.
why would you show the number of units? And that adds up to their total units over here on the left. So I would show the number of units that are renovating. Like I said, it's
Right.
confusing. Maybe it's
Right.
just the way it's presented, but it's quite confusing.
All right,
But
that
you're
makes
right,
sense.
Litan, that if you took the 1 bedroom, 1 bath large and the 2 bedroom, 2 baths and added those together, that's about the number of units they need to renovate. So possibly that is, but we don't know.
Yeah, they just need to mention it, right, and give some more clarity on that, I guess. All right. Now here's a pro forma. This is small, tiny. I hope you guys can see it. I'm gonna try and zoom in a bit. Hans, yeah, you had some remarks on this.
Yeah, so I like that he shows physical and economic occupancy assumptions. Usually you have to ask for that from the sponsor, but it's right here. As long as you blow up the page, you can see it. The assumptions in the year one income growth seem relatively reasonable to me. I didn't see anything that jumped out per se. I didn't study it detailed, but the assumptions don't, seem terribly aggressive at all to me. I did note that the expenses are reduced quite heavily compared to the seller. So I'd ask for other properties, P&Ls in the market, in particular his, because he said he owns 2 or 3 others in the market. I'd want to understand why, is he running his other properties at the same expense ratio as he's projecting he's going to run this one. Typically expense ratio under 40% is pretty low for multifamily. Now it depends on what market you're in. Like, I don't own properties in Arizona, so perhaps the property taxes, et cetera, are much lower and insurance are lower there such that you can. But I would just want to see examples of his current properties. Are they running this lean? But they may be just fine. It's just maybe a market thing.
Right. Mike, any thoughts?
The only other thing, Hans, what did you think about? I do like that he had the economic versus physical vacancy up at the top. What did you think about that? You're looking at like 3 years in and 4 years in, and you still have a somewhat significant difference between the economic occupancy versus physical. I would have thought that you would have those equal at that point in time because you would have your rents up to market by then.
Well, but that also takes into account bad debt and depending on how he's calculating economics, some people calculate it differently. I don't think you will ever have them the same. There's always going to be a difference between physical and economic.
All right. But overall, I mean, the fact that they have this detailed performer, I think it's a good part of this deck that they put it in so we can dive into the numbers.
One thing I probably would do if I was looking at this deal in detail, I would also look at this final cash flow number, whatever it is at the bottom. I can't see it. What is the last line? Okay, so unfortunately, he doesn't show. The only thing I would want to see is I'd want to see net operating income less all expenses below the line, debt payments down to net cash flow. So I can get a sense, am I getting, there's some deals where the reason I want to see this is because I want to see the final cash flow number at the bottom of this, not the net operating income. So that, which means you need to drop out other cash things like mortgage payments, some corporate costs, whatever those are, so I can get to a cash flow number. And then you can do a quick calc and say, okay, they're telling me I'm going to make, say, 4% in year 2 or whatever, or 2% in year 1. Is that actually being generated with a property, or are extra proceeds being raised to pay me back my own equity? I'm not saying he's doing this at all. I'm just using this as an example that if I have that detail, I can then tell to make sure that the property itself is actually generating cash flow to pay the distributions that the sponsor is projecting.
Yeah. So bottom line, we want sort of the cash balance, cash flow as another line item here, so we can dive deeper into that.
Okay.
Yeah.
All right.
Yeah. It's nice that he included this detail for us in the
right.
Very nice.
All right. Moving on. Sensitivity analysis, stress testing, thoughts.
Number one, kudos for him for including this. You don't see this very often, and I love it because I always want to see this. So it's great that he included this. I'm assuming this is for common equity again. It's not labeled, but I'm guessing it's just for this normal common equity. One question I would ask after looking at this is, what is the going in cap rate and how does he calculate that? Because if I don't know what, if the going in cap rate is, 5.5, why does he think he can sell it at 5? Or if it's, 4.75 and he's selling at 5, it's just, you need to understand what the going in cap rate is to have a general idea of whether this exit cap is within the, conservative range. The cap rate range is pretty tight. You notice it only goes from 4.7 to 5.3. So it only goes, 0.6%. And I'd want to at least see a 6 cap exit to see what that would do to returns. And I want rent growth as part of this, because you can't assume you get upgrades and rent growth at the same time when economic occupancy is going down. Notice one of his knobs here is economic occupancy. So you can't assume you get upgrades and then you get rent growth, but yet economic occupancy is going down at the same time. So I do like the scenario analysis, but I would ask these kind of questions around it.
Right, Mike?
I agree. I like to see this. I'm glad that he's acknowledging it and that there's variance that way. And you can spell it out, but I'd like to see this with wider margins and like Con said, know what the initial cap rate was. Another thing that we didn't, just because I'm thinking of it, not that it has anything to do with this slide, but the other thing that they didn't go over is really like what the debt is. Like we see the debt that it's 3 years, but again, I like to know what exactly it looks like, what they're paying, that kind of thing. And that wasn't spelled out in here either. So that's another thing I'd be asking.
Right. But overall, the fact that this is here is
great.
Yeah, it's good. All right. Let's see what we have next here. All right. And again, giving back testimonials, giving you more sort of confidence in the operator.
There is a couple other items that I would ask as an LP. There's no sources and uses provided in this deck. I would definitely ask for that. And then there's no details at all on sponsor fees anywhere in the deck.
Mm-hmm.
So we know what the waterfall is, but we don't have any idea what his acquisition fees are. Are there any loan fees or any disposition fees, or what's the asset management fee? Are they, if he's the management company, what is the management fee? I'd probably calculate that from the pro forma, but for the most part, there's no details on fees. So it's really hard for me to gauge if interests are aligned here without understanding the full picture.
Agree.
I'd also add the fact that they're laying out 2-3 years here, and then in other slides, talk about 5 years in the pro forma and the whatever we saw it up here, the projected returns. So I think, those are probably 3 points for this, for questions to be asked on this deck. But overall, I'd say this is a well laid out deck, a lot of information that we haven't seen in other decks, some questions to be asked. But that's how I'd sum it up. Would you guys say something different about it?
No,
I agree.
All right, awesome. Well, another deck done. Hope that was helpful for the LPs listening, watching. Keep on following us for more decks. And as usual, guys, thanks a lot. This was awesome.